Have you ever wondered, how are Bursa Malaysia's marketplace being monitored? Would you like to know how the marketplace is maintained orderly and fair? Welcome to Bursa Malaysia. We are the frontline regulator of the equity and derivatives markets. So, what does this mean for you? Through Bursa Malaysia regulation, we ensure the markets you invest in are orderly and fair, so that you have timely, accurate, and complete information to make informed investment decisions. Are able to trade in a fair and efficient environment. Have confidence in your brokers to provide secure and trusted services to you. So, how do we protect the marketplace? We have multidisciplinary teams in Bursa Malaysia regulation that focus on specific areas while collaborating with each other to provide a comprehensive network of safeguards for investor protection. We also work closely with other regulators and law enforcement agencies. Real-time surveillance of the market. We have a market surveillance team that acts as your market police. They monitor the stock market against irregular trading activities in day-to-day trading. This team uses an automated surveillance system to monitor trading in the equity and derivatives markets in real time. Should irregular trading activities be detected, this team of specialized analysts will fact-check and engage the brokers involved for their immediate action. Supervision of intermediaries. As safeguarding the integrity of the marketplace is paramount to us, our intermediary supervision team secures the protection of your trading and deposits through consistent broker monitoring and inspection. Disclosure. Continuing listing obligations and gatekeeping of listed companies or products. To be ASEAN's leading, sustainable, and globally connected marketplace, Bursa Malaysia places high emphasis on the quality of our listed companies. This begins from the approving of new listings on the exchange, through to ensuring that listed companies remain of quality through governance and compliance. As it is imperative for investors to be well informed in the fast-paced financial world, Bursa Malaysia regulations listing and corporate surveillance teams monitor companies' corporate announcements so that they are disseminated to you in a timely and accurate manner. Enforcement action is taken should there be any failure to do so, or should there be any material inaccuracies to the announcements made. As we are also a venue for listed companies' secondary fundraising, our relevant departments work together to ensure investors' funds are always used as mandated. We have a dedicated team of finance experts to examine corporate disclosures, including financial reports, so that they are accurate and timely that you can rely on. Within Bursa Malaysia regulation, we have subject matter experts that look at the various international sustainability reporting frameworks that are constantly evolving to ensure that our disclosure requirements are appropriately benchmarked. This ultimately drives the desired improvements in our PLC sustainability disclosures as well as practices. Taking enforcement action. So what happens when the persons are regulated by us? Be they brokers, advisors, listed companies, directors, or their representatives, breach our rules. Appropriate action will be taken against them. The types of action taken would depend on the severity of the breach. Suspected breaches will be investigated, and enforcement actions will be taken if the breach is proven. Our enforcement proceedings and actions are consistent and fair as cases are discussed in a robust manner through our regulatory committees, comprising independent individuals with relevant experience and backgrounds. Policy and rulemaking. Bursa regulation is the guardian to the 10 rule books of the securities and derivatives markets. Rules drawn up by the regulatory policy and advisory team are always outcome-focused. Industry or public consultations with the relevant key stakeholders will be undertaken, alongside rigorous benchmarking processes to ensure the rules are relevant, effective, fit for purpose, and on par with international standards. Each multidisciplinary team in Bursa Malaysia regulation is intertwined and interact proactively to ensure high standards in market integrity.
Hi everyone! Welcome and thank you for joining us tonight. This session is brought to you by Bursa Malaysia and managed by LifeCharm. My name is Atira and I'll be your moderator for today's session. So, our topic tonight is Uncover the Investment Potential of Malaysia REIT Market. Did you know you can invest in the real estate without owning a single property and still earn a halal income? Sharia compliant rates let you grow your wealth through property investment that follow Islamic principles, no riba, no non-halal activities. With a small amount of money, you can invest in the big properties like malls, office, and hospital, and you will get a regular dividend income. So, today we are very honored to have Miss Afifa Ishaq to share her insight on uncover the investment potential of Malaysia IREITs market. Before we start, just a quick disclaimer. Everything shared in these sessions is for educational purpose only. Nothing here should be taken as direct advice to buy or sell any securities. Please always do your own due diligence before making any investment decisions. Let me now introduce our guest speaker, Miss Afifa Shah. Miss Afifa Shah is a rate analyst at Affin Huang Investment Bank. She covering Malaysia rates since sectors since 2022. She has active coverage of 7 rates spanning large cap to small cap names, focusing on sectors such as retail, office, industrial, and hospitality. She focuses on thematic research and market trend analysis, often drawing on first-hand insight from industry experts across the rate market. She also worked closely with stakeholders in the red space, using this connection to build a well-rounded understanding of the sector and provide informed commentary for investors. We are really glad to have her with us tonight. Let's give a warm welcome to Miss Afifa Shah. Hi, Miss Afifa. How are you doing today? I hope you
Hi.
enjoyed.
Hello. Hi, Atira.
Hi.
Hi, everyone. Thank you so much for having me for today's
Welcome.
sharing session on Islamic REITs in Malaysia market. I am so happy to be here and I can't wait to share with you what I have on my views on Islamic REITs and also to educate everyone on how Islamic REIT is in Malaysia.
So I will pass it to you so you can share the screen. No?
All right, thanks.
You're welcome.
Okay. All right, can everyone see my screen? Okay, I believe my screen is already um, displaying the slides. All right. Okay. So hello everyone. So I think Atira has already gave a very brief introduction of myself, but I'll reintroduce myself again. So I'm Afifa. From Affin Huang Investment Bank. I am the REIT analyst, have been covering the sector for about close to 3 years. And for tonight, basically the sharing session would be on uncovering the investment potential of Malaysia Islamic REIT market. Okay, so I think before we jump into this sharing session, I really hope that if there's any questions or there's any thoughts in mind, feel free to just post your questions on the chat box or on the question box lah, during the Q&A session, or you can also prep some of the questions before we start with the Q&A session. Okay, I'll be explaining first on the learning outcomes that we will gain after this session. So I think there's about six pointers that I'll be highlighting. So of course, firstly is what's the meaning of a real estate investment trust or REITs lah in short. So, and then the second one would be on how do we define a Sharia compliant REIT, and also what's important for us to know thirdly would be on why we invest in REITs. And then, of course, we also need to understand the differentiation or the differences between different kinds of REITs in Malaysia. And then we will also understand about the differences between an Islamic REIT and a conventional REIT. And lastly, I think what's important when we want to understand better about Islamic REITs is, of course, on the Sharia screening process to ensure compliance across Islamic REITs. Okay, so what is real estate investment trust or REITs in short? So I think REITs, what we have to understand is basically it's a type of company or a collective investment scheme that invests in a portfolio of income generating real estate assets with the objective to distribute regular income distribution to the unit holders of the REIT. So it's like a type of company that owns and manage income generating real estates such as shopping malls, hospitals, offices, and industrial buildings. So I think if you look into this visual, I think it's quite interesting for you to understand better how you want to compare REITs with other types of asset class. So just think REITs as like a unit trust, but instead of investing in stocks or bonds, a REIT actually invests in real estates or assets. So basically, investors like all of you can buy units of a REIT on the stock exchange, just like buying shares of a company. So in return, the REIT collects rental income from its properties and also pays most of the income to unit holders as dividends, or a technical term that is commonly used in the REIT market would be distributions lah. So that's why many unit holders or investors see REITs as a good source of regular income. I think just to let everyone understand better why we call it as distributions instead of dividends, I think what's worth to highlight here is because REITs is a trust, and their income comes from property rentals, not business profits like a regular company. So instead of paying out dividends like most of the businesses or companies do to shareholders, REITs pay distributions to unit holders, because most of the income comes from rental earnings and not from profits of a business. So basically, a REIT would collect rents, deduct expenses, and distribute most of the income directly to unit holders. And to enjoy tax exemptions, REITs in Malaysia must distribute at least 90% of its income, of its distributable income. And this is why it's called a distribution law, not a dividend under the tax law. So in short, a REIT lets you invest in property without having to buy and manage buildings yourself. So I think if you look into this visual, basically this is, you can imagine yourself choosing between an ASB or a REIT. So I think if you look into ASB, it's like a big pool of, it's like a big pool managed by PNB, whereby they invest your money into companies and also other kinds of assets. And every year you get a share of profits. This would be your income distribution. So if you look into REITs, like I explained just now, it's like imagine a REIT as a pool of money that is being used to buy buildings like malls or offices, and these buildings are being rented out, and the rental income is shared with investors like you. So the way you can think of REITs is like owning a part of a building, but you don't have to deal with tenants or repairs, so you just enjoy the regular income. Meanwhile, if you look into ASB, it's very much stable and also a low risk way to grow your money over time lah. Next, what we have to understand, or typically when we look into REITs, we will always compare with other common investment options. These are some of the few options that are commonly being compared with REITs. There are five actually on screen. So firstly would be your fixed deposits or your savings account. This would be coming from fixed deposits being offered by the banks. It can be coming from Maybank, CIMB, or any kinds of banks that you are familiar with. So when we look into fixed deposits, definitely it's capital protected, but the returns, I would say it's a bit low because it's basically coming from the effect of your OPR, your interest rates of a particular country. And of course, there's no exposure to market or inflation growth. It's basically directly tied to changes in interest rates of a particular company, of a particular country. So in this case, for Malaysia, it's our overnight policy rate lah, your OPR. So if we want to compare with our REITs, I think REITs would offer higher returns in comparison to your fixed deposits, but it would come with a moderate risk. Next, second option would be your unit trust or your EPF retirement schemes. I think if we look into unit trust or your EPF retirement schemes, basically it is professionally managed by the institutional fund management companies. I mean, if you look into ASB, it's being managed by PNB. For our retirement scheme, in general, it's being managed by EPF. And I think if we look into how the mechanism works, like for unit trusts or EPFs or your retirement schemes, any sorts of retirement schemes, how it works, they actually invest in diversified businesses and also different kinds of asset classes. So I would say if you want to use comparison between unit trusts, retirement schemes, and also REITs, they are actually quite similar in structure. But for REITs, it's much more specifically focusing on real estates lah, which goes by it names itself, which is real estate investment trust. The third option would be your stocks or your equities lah. I think this is something that is commonly being played around or being traded by our fellow investors. If you look into the stock market or equities, basically the potential for higher returns is there definitely, but I would say it's volatile because it's definitely based on the macro factors, the market conditions. And I think if we understand better about the stocks or companies that you invest in, the earnings also depend largely on the performance itself, and the performance of the company is also being related to market conditions lah. So I think if we look into the comparison with REITs, I think for REITs, the specialty of you investing into REITs is that it offers more stable income through distribution yields. So I think if you want to see in terms of capital appreciation, capital gains in terms of share price, of course, that's where the stocks or the equities would come in. But REITs, if you want to look into stable distribution yields, then that's the kind of asset class, or that's the kind of segment that you would want to jump in lah. Fourth option would be your bonds. Think the most relatable one would be your MGS 10-year bond yield. It's a type of fixed income, relatively safe, but in terms of getting returns, bonds in terms of returns is much more lower lah, versus your equities and also your REITs. If you look into comparison between bonds and REITs, both are yield focused for bonds and REITs. But then REITs, what they can offer you is also the additional side on getting potential for capital appreciation lah. But I would say capital appreciation, it will be around 10 to 20% depending on the fundamentals of the REIT player itself. But it offers a combination of both your yields, which is a defensive game, and also potential for capital appreciation. And last option, or final, another option that people always compare between REITs would also be your real estates. So this real estates, meaning to say it's basically a direct property investment whereby you own the asset, whereby the ownership of the asset would be fully owned by you. And it's considered like a physical ownership of property where you buy the asset and you lease it out to tenants, and everything is at your own cost, at your own management as well. So of course, if you look into direct property investment, high capital is required and liquidity is definitely lower. So if you want to compare with REITs, I think REITs offer the access to property rental income without having the ownership hassle, whereby you have to deal with a lot of different kind of tenants. Sometimes they can be good, they can be bad. And I think in terms of maintaining the asset itself, it can be very burdening as well. So I think coming from the angle of REITs, they would offer the access of having or gaining property rental income without the ownership hassle. All right, so why people invest in REITs? I think if we look into how REITs work, like based on the explanation given just now, like I said, it gives you the combination of defensive or consistent dividends or distributions, and also it allows for capital gains in terms of share prices. So if we look into the reasonings why people invest in REITs, of course, the root cause would be on offering regular distributions, and it's backed by the investment properties that the REITs are involved in. So these are some of the few reasons which is commonly being used on why people invest in REITs. I think first and foremost, definitely affordability. When we talk about affordability, unlike buying your physical property, which can cost hundreds of thousands or even millions of ringgit if you want to combine into like your property portfolio, REITs actually allow you to start investing in real estate with just a small amount of capital. So you don't have to come up with a bank loan, a housing loan, just to own an asset on your own. You can just invest in REITs with just a small amount of capital. You can even start with even less than 1,000 ringgit, and that already makes it accessible to a wider range of investors, especially for beginners like some of you that is on the line right now. Next is on, of course, stable income stream. So when we talk about stable income stream, one of the key attractions of a REIT is, of course, the regular dividend or the regular distribution payouts. So in Malaysia, like I highlighted just now, REITs are required to distribute at least 90% of their income to enjoy tax transparency. So you're essentially getting a steady flow of income, typically on a quarterly or a semi-annual basis. And then third one is, of course, on the professional management. When we talk about professional management, you don't have to worry about managing tenants, like I highlighted just now. When you're dealing with direct property investment, you need to manage the tenants, manage the asset alone by yourself. If you're not an expert in that area, it would be very burdening for you. So if you invest in REITs, you don't have to be managing tenants, you don't have to collect rents on your own, or even fix your leaking pipes at your own property that you just bought. So everything is handled by a professional REIT manager whose job is to maximize the value of the asset and also the performance of the asset or the portfolio. Next one is on the exposure to large scale asset. I think when I started covering REITs, this is some of the things that I like to highlight to investors. Basically, when we talk about exposure to large scale assets, I think some of you might be dreaming of owning a shopping mall, or a shopping mall like yours, right? KLCC, Pavilion KL, but definitely for us as an individual alone, it's very impossible for us to have that kind of ownership on prime shopping malls like that. So through a REIT, you get that indirect ownership of high value properties like your retail malls, like I mentioned just now, lah, your Circle LCC, your Pavilion KL, your Subway Pyramid, Mid Valley, Mega Mall. You can also have indirect ownerships on hospitals, office towers, industrial assets as well. So this is definitely the assets that would otherwise be out of reach lah for most individual investors. So this is where the REITs would come in to actually allow you to have exposure to large scale assets. And then next one would be on portfolio diversification. So when we talk about portfolio diversification, real estates, they behave differently from stocks and bonds. So having REITs in your portfolio can actually help reduce volatility and improve overall risk adjusted returns, especially during a market downturn, or now we're heading towards a market volatility, especially since the start of the year with the uncertainty of Trump's tariff. So you can see that REITs are the most outperforming sector if you want to compare with the other export driven sectors like your industrials, your tech sectors and whatnot, whereby they are being heavily impacted by this uncertainty in Trump's tariff. So that's where REITs come in, whereby it's a defensive kind of sector, whereby they would offer you the distributions, dividends on a quarterly basis. And I think if we look into REITs in Malaysia market, basically our portfolio is very much domestic centric lah. So nothing much that would be a negative impact lah for Malaysia REITs. If you want to talk about the global headwinds right now. And of course, finally, it's hassle-free. So when we talk about hassle-free, I think it's pretty much overlapping with some of the points that I mentioned just now. Why it's hassle-free? Because you enjoy the benefits of property investment without the headaches that come with direct ownership. So you don't have to deal with legal paperwork, maintenance, or tenant issues lah. So whether you're looking for income, diversification, or ease of investment, REITs will offer a practical and efficient way lah to invest in real estate. All right, so if we look into the next slide, I think these are just some of the charts that would justify on the performance of Malaysia REITs, which is reflected in total returns. So when we talk about total returns, it's the combination of your capital gains and also the distribution yield lah. So you can see that in terms of the distribution yield is pretty much stable. I think this chart actually shows you that that two kinds of scenario lah. It was during the COVID-19 pandemic and also post-pandemic. So of course during the COVID-19 pandemic, REITs would be the one that is not appealing, because I think if you look into the pandemic at that time, you cannot even you have to stay at home, you cannot even visit shopping malls. It's only those neighborhood malls that are only be allowed to be visited by us or by individuals. So which is why you can see capital in terms of share price performance for REITs is not there at that point of time, which is why there's quite a big loss during the COVID-19 pandemic. But then as the market recovers, the pandemic slowly fades, you can see that share price has recovered. And I think if we look into the distribution yield, it's pretty much stable. And of course, if we look into total returns, of course, when we look into REITs against other asset classes like equities or bonds, especially for income-focused investors, you can see that even if there's a drop in share prices, they can still offer you defensive or consistent dividends lah. So in summary, I think when we look into REITs, basically they show you the best measure in terms of total returns, whereby you can assess how REITs perform over time. And in the Malaysia context, return has largely been driven by stable recurring income supported by high occupancy rates and also long-term leases for the REITs in Malaysia. This would be a chart whereby it shows that the KL REIT index outperformed FBM KLCI by 9%. Basically, this chart is actually a time frame from May in 2019 until May 2025 lah. But in terms of the year to date that we are trying to show is basically coming from January until May of this year. So you can see that the REIT has outperformed FBM KLCI by 9%, and this is also because of the market being volatile at this point of time, which is why, like I mentioned just now, REITs during the period of market uncertainty or during periods of global headwinds, REITs would be the one that is most appealing for investors because of the defensiveness of the sector and because of the consistent dividends that you'll be receiving from REIT players. So when we wanna also justify about how REITs would be appealing as well, of course we need to do some comparisons with other income asset class. So Malaysia REITs remain one of the highest yielding listed instruments in Malaysia. So if we look into last year in 2024, the REITs, they can offer you distribution yields or dividend yields in the range of 6% to 8%, and that's considered high because you haven't priced in the capital gains that you receive coming from the share price moving upwards. And if you look into total returns, definitely it's even higher lah. So coming from the distribution yield alone, you can already capture that range of 6 to 8%. Meanwhile, if you look into the 1 year fixed deposits, the yield or the returns that you are expecting will only be in the range of 3.3 to 3.8% based on the performance last year. And I think with the announcement of Bank Negara cutting the OPR, you might expect we might expect that fixed deposits, the rates would be even lower for this year, or I would say it's much more pronounced in 2026. Same goes with the Malaysia government bonds, which is your 10-year MGS. I think if we look into the yield last year, it's at 3.43%. So of course, the yield spread between your 10-year MGS and also your REITs is even bigger if you look into the comparison. But I think if you look into the other unit trusts and retirement schemes, EPF has done a very great job. They managed to offer about a 6.3% return or yield, and this is considered impressive because this would be the highest that they've achieved so far. And if you look into ASB, 5.75%, also considered an impressive one. But then I think what we have to understand, everything when we look into your EPF, your ASB, it's heavily tied to the market condition. So it depends. When the market is bad, then you might expect yields across unit trusts or retirement schemes to also reflect the same kind of number or the same kind of a little bit of bad market condition. Unlike the REITs, I think REITs, because of the stable rental income that they manage to secure and whatnot, which is why the yield would still be stable, I would say. So next is we have to also understand the growth strategies of a REIT. And these are some of the things or some of the initiatives that would offer long-term growth pathways for REITs. These are your strategic acquisitions. Strategic acquisitions is basically from how you want to understand better is basically REITs on purchasing assets that could actually bring higher returns or higher rental incomes to the group, and also this would translate into higher distributions for investors. Next one would be on asset enhancement initiatives. I would say this is much more of a technical term that is commonly used by REIT players, but in layman terms, it's just on how the REITs are trying their best to maximize the value or the quality of the asset that they already acquired and already parked into their portfolio. So asset enhancement initiatives can be in form of reconfiguration or refurbishment of malls or reshuffling of tenant mix and whatnot. And when we talk about capital management, so capital management is much more of how the REITs can actually strengthen their balance sheet lah. Because when we look into the compliance or the practices for REITs in Malaysia, there are certain requirements that the REITs need to fulfill, and much of it is on how they manage their capital, which I'll jump into that after this. And of course, lastly would be on the ESG commitments. I think for ESG commitments, it's not just for a REIT, but also a practice that is being commonly used right now nowadays. So for REITs, there's also a portion of ESG commitment that they need to actually meet in order to stay relevant and stay attractive, especially to the global audience. So when we talk about strategic property acquisitions, I think what's worth to keep track of is, I think this is being posted on the news, online news articles, on some of the acquisitions that is announced by any kind of REIT player. So I think some of the recent notable transactions being performed by REIT players would be like your KLCC Staple Group. I think this announcement was actually made in 2024, whereby they actually acquired a 40% remaining stake in Sureka LCC Sendirian Berhad. So of course, coming from news like this would be a positive development lah for a REIT player, because when you do asset acquisitions, it would translate into higher rentals, and that's gonna become a growth lah in terms of your revenue and your profit as well. So coming from the growth in revenue and your profit, this will also translate into higher distributions. So aside from KLCC, some of the other REIT players that are active on the asset acquisition front would be Sunway REIT. I think for Sunway REIT, they did announce a number of acquisitions, especially in 2024, whereby they acquired the 163 Retail Park Mall, which is located in Montiara. They also bought the Kluang Mall in Johor, and I think recently they just completed the acquisition of Aeon Mall Seri Manjung in Perak. And then next would be Axis REIT. I think those who are not familiar with Axis REIT is an industrial focused REIT player, whereby the exposure is largely on the logistic warehouses, your manufacturing facilities, and also a little bit of offices and also hypermarkets lah. But I would say their focus is mainly on the industrial assets. So I think for Axis REIT, the recent acquisition, I think they just announced it few days ago, which is the acquisition of a warehouse in Port Klang, and also coming from another one more acquisition, this would be the two properties that they just acquired from Cycle and Carriage Bintang. And I think the key point of this is actually to show how active Axis REIT lah in terms of asset acquisitions, because these are just two of the selected ones that I just posted onto the screen. But if you look into the other, sorry, is my screen? Hold on.
Miss Afifah okay tak tu?
I think my screen just got unshared.
Boleh share ke? Boleh share balik?
Hold on. Sorry,
It's okay.
some 5 minutes of break.
Sorry everyone, we're having a technical issue for now. We will be right back soon. Thank you. Okay. Um for those who have like a question, you guys can type the question in the Q&A box below. So in the Q&A session later, we will try to read your question and answer the questions. So everyone, it looks like we're experiencing a small technical issue. At the moment, please bear with us for a few minutes. We will come back soon. For those who have like a question to ask Miss Afifa later on in the Q&A session, you guys can type the question on the Q&A box, okay? So I will read out later. Thank you. Miss Afifa.
Hi, sorry. I'm still figuring out how to.
Kalau let's say if you cannot share, I can share it for you.
Okay, can. Think that would be better lah now.
Okay, wait. Uh, slide page berapa ya?
Okay, sekejap. I think I might
30.
be able to uh connect back with my Zoom.
Wait. Okay. Okay. Can you see my screen, Miss
Okay,
Afifa?
I
Uh,
think
what page?
okay.
Uh,
Uh, all right. Let me try and share my screen. Maybe you can unshare.
oh, okay, okay.
Really sorry for the sudden technical issue. Okay. Can anyone see my screen right now?
I cannot see your screen right now. Okay,
Okay.
okay, okay, okay.
It's already in, kan?
Yes.
All right. Okay. Really sorry. So continuing back to the points just now, right? Think we just touched on exist REIT, right? So basically, I think the key point of exist REIT in the asset acquisition front, I think what you see on screen is just the selected ones that I managed to post onto this slide. But actually, there's many more. I think if we look into last year, exist REIT has also completed about 6 assets acquisitions for 2024. So that's quite an impressive move lah coming from Axis REIT, given on how active they are on acquiring new assets. Next one will be on Pavilion REIT. I think for Pavilion REIT, is also quite recent, whereby they just announced the acquisition of this two iconic KL hotels. This would be your Banyan Tree KL and also your Pavilion Hotel KL lah. I think they just made the announcement last year in December, and they just completed the acquisition. So if we look into another acquisition that Pavilion REIT did was on Pavilion Bukit Jalil lah. But I think looking at this announcement, it actually took place in the year of 2022, and it completed in 2023. Okay, so next one would be on the AIs. Okay, so like I mentioned just now, AIs is a technical term that is commonly used by REIT player, whereby if you go through the annual reports, AIs is something that is always being repeated lah on the annual reports. Basically, AIs, when we talk about asset enhancement initiatives, it's basically strategic enhancements to maximize property value. And what is the example of AIs that can be done by a lead player is sometimes it can be done by creating additional net lettable area. I would say in short is NLA. NLA ni is basically you can imagine it like the size that is or the space that is being allowed lah to be let or to be leased out to tenants. And how it's being done when we talk about creating additional NLA is through reconfiguration of common areas. So by doing this, it can actually boost the overall revenue potential of the property and also enhance the yield of the property itself. Um, Next one is also on upgrading building facilities and amenities to enhance operating efficiencies. So when we talk about enhancing operating efficiencies, things that you can do is by installing solar panels or installing LED lights, replacing it with the ones that doesn't really give you that good energy efficiency. And these are also some of the things that the REITs usually apply or practice when it comes to upgrading their building facilities. And what it is good about this is, of course, on the savings on operational costs, whereby it would lead to a more cost-effective management model for the REITs. Next one would be on providing the right space for the right tenant to stay relevant and also maintain competitiveness in the market. So how it's being done is by creating customizable and innovative spaces to attract high-quality tenants, and this will also foster the long-term opportunities lah for the REIT itself. So I think if I explain a lot of this narrative, it's very good to also relate with some of the examples or some of the recent AEIs being done by the REIT players. I think some of the notable examples that I would be happy to share is on Sunway REIT. I think for Sunway REIT, those who are familiar with the malls or those who are frequent visitors of some of the Sunway malls, like your Sunway Pyramid, your Sunway Carnival that is located in Penang, there has been a major reconfiguration being done at those two malls. Whereby for Sunway Pyramid, basically what they did is they replaced their former tenant, which is their former anchor tenant, which is the Aeon departmental stores in the Oasis section, with multiple sets of tenants. And coming from this kind of arrangement, what is good about this is basically Sunway REIT managed to get different kinds of premium, different kinds of rental rates from different kinds of tenants, depending on the nature of the business that the tenants are operating in. Meanwhile, if you look into only having departmental stores being a larger format and whatnot in a mall, rental rates would be structurally lower because they already occupy big volumes or bigger size or bigger space at the mall. So of course they managed to negotiate for lower rental rates lah because of the big volume that they managed to get. But I think it's much more of a strategic move lah of what Sunway REIT is doing right now with having different kinds of tenants in one mall instead of relying solely on a departmental store, especially when the mall is sort of, I would say, irrelevant lah to be having departmental stores in Klang Valley right now. Next one would be on IGB REIT. For IGB REIT, also same story like Sunway REIT. They just did some reconfiguration works for Mid Valley Mega Mall, whereby they downsized their tenant, which is Metro Jaya. Metro Jaya, I would say, is also kind of like a departmental store as well. So same story like Sunway REIT. Basically, they downsized Metro Jaya and replaced some of the space previously occupied by Metro Jaya with multiple sets of tenants lah. Same like Sunway REIT, but for Sunway REIT, they completely get Aeon departmental stores to leave the mall and replace it with multiple tenants. But for Mid Valley Mega Mall, it's just a matter of downsizing Metro Jaya only. If you look into the other AIs, I would say these are kind of like minor AIs lah, whereby the capex is not that big. You don't need to use your borrowings, or you need to actually apply loans for capex like this or activities like this. These are basically the reshuffling of existing and new tenants to different store locations lah in the mall, and it's being commonly practiced by Suria KLCC and Pavilion KL, which is why sometimes you can see, like for example, for Suria KLCC, the Two Suns bistro, the Two Suns restaurant. At first, it was initially located at the high floor, but now they already managed to occupy a bigger space at the first floor, if I'm not mistaken. And that's just one of the ways of KLCC reshuffling their tenants to different store locations, because when we look into the initial location of Two Suns, it's quite packed, the restaurant, and it's even better for them to actually get a bigger space lah. And this is the one that is located at the first floor instead of the upper one. For Axis REIT, I think there's also a lot of AIs, but the most significant one would be on the development of Bukit Raja Distribution Centre 2. I think this is another industrial asset owned by Axis REIT, whereby they developed this one industrial asset from scratch onto an empty land and list it out lah to tenants. And this is also based on requirements being set by the tenants that has already signed the agreements. And I would say it's more of like a build to lease kind of asset development lah by Axis REIT, whereby they already secure a tenant, and this tenant already mentioned what kind of layout, what kind of requirements that they want for their particular asset. So next would be on strengthening the balance sheets, whereby this would be touching on the managing the capitals of REITs. So what we have to understand for REITs, a lot of the requirements are coming from the balance sheet, and one of it is of course to optimize the capital structure and also the cost of capital. And how it's being done is of course by achieving an optimal mix of debt and equity to minimize the cost of capital. And benefits of this is, of course, it would actually help to reduce the overall financing costs and also enhance shareholder value. And when we look into debt funding as well, it's good for REITs to diversify the sources of their debt funding, and this would be done by getting access from debt from different kinds of regions or different kinds of countries. So it can be USD denominated or ringgit denominated debts. Benefits of this is, of course, to minimize the impact of local economic downturns and also broadens the funding opportunities. So when we talk about local economic downturns, sometimes let's say in the case of, for example, OPR remains elevated at a certain percentage or a certain range, but then since you already have access to other kinds of foreign denominated debt, whereby at that point of time interest rates are much more easing or much more lower, then that would actually help the REITs to minimize the impact of local economic downturns. And next one would be on managing the interest rate risk through hedging strategies. So they can actually use swaps to exchange variable rate debt for fixed rate debts, because I think having a fixed rate debt is pretty much stable, because in the case of interest rates going up, then REITs would benefit coming from fixed rate debts, whereby it won't follow the same path as rising OPRs, because the debts are already fixed in terms of the rates. And of course, the benefits of this, it would stabilize the interest expenses and also protects against the rising interest rates. Another one more strategy that is commonly being practiced by REITs is, of course, they would manage the debt maturity profile to minimize refinancing risk. So some of the strategies is, of course, through spreading out the debt maturities over multiple years rather than having them all due at once. Because if you have them all due at once, it's going to be a burden for the REIT, because it's much more better if they can balance stability and flexibility when it comes to long-term debt, so that you don't have to pay lump sum of interest costs during that particular year. And I think another example for this kind of the strategy, you can refer to this REIT debt maturity schedule. So you can consider a REIT with a total debt of 500 million ringgit. An optimized debt maturity profile might look like this, whereby it's being spreaded throughout a long period of years. So I think if you look into this kind of profile, this kind of debt maturity schedule, it would ensure that the REIT does not face a large lump sum repayment in any single year. Thereby, it can also manage their cash flow efficiently. Okay, so when we talk about debts, capital management, I think some of the things that we really need to keep track of is the debt to asset level, or I would say the gearing ratio of a REIT, because as required by Securities Commission, a REIT must actually hold a gearing ratio of 50% and below, and that's a requirement by Securities Commission. Reasoning for this is very much straightforward, because of course, because SC being the regulator of a REIT, they also want to see the REITs to actually manage their portfolio efficiently. So by having this kind of requirement, you wouldn't see REITs to simply purchase assets many times without taking care of their gearing levels. So this is one of the things that Securities Commission would monitor lah for REITs. So whenever gearing ratio hits at a very critical level of like your 48% or close to 50%, that would actually limit lah the REIT from acquiring more assets. So what can they do is, of course, they need to repay back lah their borrowings. And by repaying back the borrowings, usually it's through placement exercises and whatnot. All right, so next slide would be on the sustainable growth, whereby this is when we talk about ESG commitments lah. I think this is pretty much narrative. It is just some kinds of initiative that is not just being implemented by a REIT but also by other kinds of companies. So of course, coming from REIT, the specific ones would be on getting their buildings to be certified as a green building, whereby this kind of green buildings can also command higher rental rates by attracting and retaining premium tenants who prioritize sustainability. So usually when we talk about green buildings, it is something that is commonly seen across the office assets, whereby I think if you look at the offices like your Exchange 106, your 118, so these are considered as green buildings because, I mean, the nature of it being a newly developed building, a newly developed office, and of course, there's a lot of ESG initiatives being implemented in these offices. So that's why they are being certified as a green building, and which is why you can see most of the tenants that occupy the space at those office are all your MNCs and also the big companies lah. Unlike the outdated office spaces, most of the tenants are, I wouldn't say it's not a multinational corporations, but it's like your SMEs and whatnot. Hence, the reason for the rental rates for obsolete office spaces to be lower lah than what you see in certified green buildings of office assets. Next one would be on sustainable finance mechanism. Basically, this kind of financing instruments are designed to deliver positive environmental impacts, such as reducing carbon emissions and promoting energy efficiency. So when we talk about green financing, basically, the REIT must actually highlight lah the purpose of this green financing. It's for what purpose? Is it for installation of solar panels or things that is involving ESG commitments lah, which is why banks could also offer green financing lah to REITs as well. And I think if you look into commitment ESG, of course, it's on really fulfilling the ESG lah, which is the environment, the social and governance, and some of the initiatives are, I think it's also a wide practice that is being implemented across different kinds of companies as well, not just a REIT. All right. So understanding different segment of REITs, I think if we look into Malaysia REITs, there's a total of 20 publicly traded REITs in Malaysia. If you see in the slides here, I think there's about 19. One that is missing would be Paradigm REIT lah, which was just listed this year. So here you can see in my slides, I try to categorize to make you understand better on the different kinds of REITs or different segment of REITs, whereby there's two, which is specialized REITs and also diversified REITs. So for specialized REITs, I'm actually highlighting on the angle on what kind of segments that they are focusing on. So of course you can see that there's a lot more on the office side, whereby this would be your KLCC, Staple Group, your Tower REIT, IGB Commercial REIT, Central REIT. So these are basically the names that are focusing mainly on office assets. Meanwhile, if you look into Al-Aqah Healthcare REIT, basically, they mainly focus on the healthcare assets. So these are your hospitals, your retirement houses and whatnot. Meanwhile, for the hospitality side, we have YTL Hospitality REIT, whereby their portfolio are mostly hotels lah, are mainly hotels, and these hotels would be coming from different countries. I mean, for the case of YTL Hospitality REIT, they have hotels in Malaysia, Australia, and also Japan. If we look into other names like Atrium REIT, Axis REIT, AME REIT, they are focusing heavily on the industrial side or the industrial assets. And for retail, we have IGB REIT, Pavilion REIT, Keep REIT, and Hectare REIT. So I think looking at some of these logos or brands like Pavilion REIT, I'm sure you are familiar with your Pavilion KL, Pavilion Bukit Jalil, whatnot. For IGB REIT, the malls that they have would be Mid Valley Mega Mall and the Gardens Mall, and they just also recently acquired Mid Valley South Key Mall, the one that is located in Johor Bahru. For Keep REIT is basically a neighborhood retail REIT player, whereby their focus is largely on neighborhood malls or suburban malls lah. Um, if we look into another set of REIT, which is known as a diversified REIT, this is where Sunway REIT, Capitaland Malaysia Trust, and Asalam is being parked on lah, whereby their exposure, their portfolio exposure is much more diversified. So they have a combination of retail, industrial, office assets, and some hotels as well. Um, and I think what's worth to also highlight is some specialty REITs. This is something that you don't see in Malaysia, but it's usually seen in developed markets like US or Singapore, lah, whereby the segment is much more niche. I mean, if you look into some of the examples, we have data center REIT, self-storage REIT, infra REIT, residential REIT, and a longer list, lah, which it does not fit into this box. But I would say if you go explore the US REIT market or the Singapore REIT market, the list is even longer lah for the number of publicly traded REITs. Unlike Malaysia, we only have about 20. Soon we might be seeing some new REIT players, which I think you guys can also explore lah on the news what REIT that will be listed soon. All right, so next is finally on understanding a Sharia compliant REIT or Islamic REIT. So I think when we look into this slide, right, it's much more easier to understand, especially as beginners. We need to understand the what, the who, where, why, and how. So what is a Sharia compliant REIT, or what is an Islamic REIT? So basically, it's a type of REIT which is structured and managed in accordance with Sharia principles. It generates rental income from halal sources and also undergoes regular Sharia screening and certification by a Sharia advisor. So where is it applicable? I think this is pretty much straightforward. Like other kinds of REITs, basically it's also being listed on Bursa Malaysia lah, but they managed to get that status lah, being an Islamic REIT or a Sharia compliant stock. Where they usually invest or what kind of exposure that they usually be involved in, they basically invest or typically invest in industrial, retail, office, and healthcare properties, but subject to where they also need to have tenants that are Sharia compliant. And I think when we look into Islamic REITs or Sharia compliant stocks, of course, it's famous or popular among institutional investors with exposure to Islamic funds or Sharia mandates. And this is names like EPF, PNB, and Tabung Haji lah. So why is it different? I mean, the difference is, of course, the comparison between an Islamic REIT and a conventional REIT. Of course, when we talk about Islamic REIT, it avoids any sort of haram business activities, or I would say non-permissible business activities. I wouldn't say it 100% avoid, but it limits lah the exposure of an Islamic REIT to haram business activities. And of course, when we talk about the audience or the target market for Islamic REIT is on the Muslim investors, whereby when we look into Islamic REITs, definitely it could ensure ethical and faith-based investing lah for the Muslim individuals. And of course, because of it being an Islamic REIT, it is also subject to stricter rules on tenant mix, rental sources, and also financial structuring. So, because of Islamic REITs having a lot of compliances and a lot of stricter rules that they need to comply with, of course, there are certain parties that oversees the compliance. So, the important persons are your Sharia advisor. So, the Sharia advisor, the role of them is they are the appointed person to ensure ongoing compliance with Sharia principles. And we also have the Sharia Advisory Committee. This is coming from Securities Commission, the regulator. Basically, they set the national standard for Sharia screening and compliance threshold, whereby when they already set all of this compliance threshold, the Sharia screenings, the standards and all. So it's the role of a Sharia advisor to make sure that all of the boxes are being ticked for an Islamic REIT in terms of making sure that the REIT itself comply with the Sharia principle. And of course, it's also coming from the help of a REIT manager, responsible of a REIT manager to be responsible for tenant selections, asset acquisitions, and also ensuring compliance with Sharia-based investment policies. So how does it work? I think this is just a very brief one whereby we'll be jumping into this more in detail after this in the next slides. But in briefly, it's basically mentioning that rental income must be sourced from Sharia compliant tenants. And if there's a mix of compliant and non-compliant activities, there's a tolerance range about 20%, which applies for an Islamic REIT with a mix of compliant and non-compliant activities. But then by the 10th year of listing or 10th year of operating the REIT business publicly, the REIT must reduce the Sharia non-compliant income to less than 5%. And of course, there's also the involvement of regular Sharia audits and also purification of non-compliant income, if any. So I think the differences between Sharia versus a conventional REITs, of course, we need to understand the names that are listed or being recognized as an Islamic REIT. So in Malaysia, out of the 20 publicly traded REITs, there's only 5 that are considered as a Sharia compliant REIT. So these are your KLCC Staple Group, Axis REIT, Al-Aqah Healthcare REIT, As-Salam REIT, and AME REIT. Meanwhile, the conventional names is Pavilion REIT, IGB REIT, YTL Hospitality REIT, Surrey REIT, Keep REIT, and the others and the rest of it. So you can see that if you look into the names here, it's much more of a retail focused REIT and also hospitality REITs And there's a reasoning why it's being parked as a conventional REIT, because I think you can see that REIT players like this, they derive significant rental from such sectors whereby it can be coming from the non-presumable activities like bars, cinemas, non-halal F&Bs, and whatnot. And of course, when we look into Islamic REITs, basically there's limited involvement in gambling, alcohol, and non-halal food production And same goes in terms of tenant mix in their retail malls. There's no such thing as non-halal based F&Bs. So you can see that if you visit Surya KLCC, you wouldn't see non-halal restaurants, but you can see pork-free restaurants So KLCC is the best example of a retail mall that really practices the Sharia compliance And then in terms of asset screening, for an Islamic REIT, like I mentioned just now, it is subject to a periodic review by the Sharia Advisory Council. Meanwhile, for conventional REIT, there's no such thing lah of them need to be screened by the SAC or the Sharia Advisory Council. Okay, so basically these are the names that are the Islamic REITs. I think if you look into KLCC Stapled Group, this basically the slides that I'll be showing after this would be the Islamic REITs. Also I'll be giving a brief overview of the company and also some of the assets that are actually the significant contributors lah to the group. I think if you look into KLCC Stapled Group, they are the largest REITs in Malaysia in terms of the size of market cap. If you look here for FY24, the market cap is at close to 15 billion ringgit, making them the biggest REIT in Malaysia. And in terms of property value, it's around 16 billion ringgit. So the assets that they have in their portfolio are the offices, like your Petronas Twin Tower, Menara Exxon Mobil, and some of the offices in the KLCC district area lah. And they also have Suria KLCC and Mandarin Oriental in their portfolio as well, which is why the property value is very big lah here for KLCC Stapled Group, given the assets that they have in their portfolio. I think if you look into the operational performance of KLCC, it has been a very impressive one. You can see that the distributions per unit that they managed to offer to investors, it's around a 10% growth year on year. So this is considered a very impressive one lah if you want to look into KLCC Stapled Group. I think in terms of the contribution of assets to the group, it's much more easy if you look into the segments. If you can see here, the top revenue contributing segments in FY24 for KLCC Stapled Group, this would be firstly coming from the offices lah. About 34% of the revenue is coming from offices, and then second one would be on the retail side, which is your Suria KLCC, and they also have management services lah, contributing about 18% to the revenue, to the group's revenue. So when we look into KLCC Stapled Group, it's not just a REIT operator, it's considered a stapled entity with the combination of a REIT and a property segment, which is why you can see that the Stapled Group actually comprises of KLCC Property Holdings Berhad and also KLCC REIT being stapled together as a stapled entity. So next would be on Axis REIT. I think for Axis REIT, it's the first and largest Islamic industrial REIT in Malaysia. So you can see that for Axis REIT, it's an industrial focused REIT player with a little bit of exposure in offices and hypermarkets as well. And you can see that the number of assets that they have in their portfolio is about 68 assets, and these are strategically located across Klang Valley, Johor, Penang, Pahang, Negeri Sembilan, and Kedah. I think if you look at this kind of locations, you can also agak-agak lah actually that for an industrial assets, the hot spots or the hot locations would of course come in Klang Valley, Johor, and Penang lah, given the industrial boom on those key states. I think if we look into the operational performance, also an impressive one. Axis REIT managed to deliver a 7% DPU growth for FY24, and I'm sure there's another one more growth to come for FY25, given the active acquisition exercises that they did last year in FY24, and full earnings contribution would come in FY25. So you can see the DPU for Axis REIT to also grow even further moving forward. And these are also some of the notable asset transactions and AEIs that they did. And for the contribution of assets in terms of revenue, because of them having about 60 assets, you can see that contribution wise coming from a single asset is not as big as what you expected lah on a standalone basis, which is why one asset can only contribute about 8%, 7%, 6% lah for the significant ones. Okay, next we also have Al-Aqsa Healthcare REIT. Al-Aqsa Healthcare REIT is also another Islamic REIT. It's the first Islamic healthcare REIT in the world, whereby the exposure is mainly on hospitals, wellness centers, colleges in Malaysia, and also retirement houses lah. And this is specifically focusing on the healthcare segment. And if you can see, the assets that they have in their portfolio are mostly coming from KPJ Group or KPJ Healthcare lah. So I think in terms of market cap size, it's about 1.1 billion ringgit. But then operational performance is not really that impressive lah, I would say, for FY24. But I think in terms of the dividend yield, the distribution yield that they're offering is also around the same range like the other REIT players as well lah. In terms of the contribution of assets for to the group's revenue, like I said, because of the number of assets that they have, it's about 23 assets, right? Which is why on a standalone basis, contribution by a single asset is only at 8 to 9% each for the significant ones. So we also have AME REIT. I think for AME REIT, this is the latest Islamic REIT being added into being a Sharia compliant stock and also being an Islamic REIT, which is previously there's only 4 Islamic REITs in Malaysia, but now we have 5, and it's coming from the addition of AME REIT lah. So when we talk about AME REIT, a little bit about the company, it's basically the second industrial focused Sharia compliant REIT, and it's backed by a sponsor, AME Elite Consortium Berhad, a construction player. And it was also just listed in main market of Bursa in 2022. So in terms of the size of portfolio, it's around 686 million ringgit. Market cap, not that big, but I would say, considering how fast they've grown within just a short period of time, I would say impressive one lah. Which is why you can see that the operational performance for FY24, the revenue has jumped up by a lot. Then it has translated into also the growth for their NPI, which is the net property income, and also the DPU as well, the distributions. So I think if you look into the assets that they're involved in or that they have exposure in, these are the manufacturing facilities, the logistic warehouses, and also dormitories lah. Dormitories are basically the dorms for the workers lah that work in the industrial assets that they have. So next we also have As-Salam REIT. I think for As-Salam REIT, it's a diversified Sharia REIT with a focus on urban retail and F&B assets. If you look into As-Salam, it's also I would say like siblings with Al-Aqsa as well. I think in terms of the portfolio that they have is very much diversified. They have about 54 assets, and these 54 assets are including the retail malls, the industrial assets, office tower, and F&B properties. Actually, if you look into this 54 assets in total, largely is coming from the F&B outlets, which is why you can see here there's about 42 KFC and Pizza Hut outlets. That's why the reason for the high number here. In terms of market cap, I would say As-Salam is a small cap REIT player. Property value about 1.2 billion ringgit. In terms of operational performance, sadly, is not as good lah as what we see with the other REITs. But in terms of the revenue contribution, I think you can see that most of it is coming from the Komta JBCC on a standalone basis, about 26%. Meanwhile, the second one would be the F&B outlets. Collectively, for 42 assets in total, it contributes about 22% lah to the group's revenue. And then they also have Maidin Hypermart Gong Badak, and this contributes about 18% to the group's revenue for FY24. Okay, so I think, of course, this is something that Muslim investors would pay a lot of attention on. It's on ensuring compliance across Islamic REITs. So there's a lot of considerations being taken on when we look into the compliance across Islamic REITs. The important ones, I would say, would be the rental income compliance. So, of course, when we talk about rental income compliance, when we look into the requirements for a rental income on Islamic REITs, rental income must come from Sharia compliant tenants, or if the tenant is involved in mixed activities, which is a combination of halal and non-halal business sources, the Sharia non-compliant portion must not exceed 20%. And this is basically a requirement being set by the Sharia Advisory Council by Securities Commission. So I think if you look into this chart here, you can see that most, or I can say all of the Islamic REITs has actually hold a percentage ratio of Sharia non-compliant rental of less than 5%. So why it's less than 5%? Because it's also being stated by Securities Commission that by the end of the 10th financial year after listing or the establishment of the Islamic REIT, they must reduce the non-permissible rental income to below 5%. And only acquire new properties if the Sharia non-compliant rental remains below 5% post-acquisition. If it's more than that, then it would limit them to acquire assets moving forward. And they also cannot acquire properties that are fully tenanted by a non-permissible businesses, even if the total non-compliant income is still within the 5 to 20% range. Okay, so next point that is also part of the important consideration when we screen an Islamic REIT is on the underlying business activities. So coming from this slide, you can see that I actually categorize what type of REITs that are typically Sharia compliant, and I already ranked here as well, whereby you can see that the REITs with high likelihood of them being an Islamic REIT are basically REITs with exposure to industrials, healthcare, and offices because of the businesses that they're involved in is pretty much not heavily exposed on the non-halal or non-permissible business activities like your retail REITs or your hospitality REITs, whereby of course the tenant mix for retail REITs, for example, of course, they have exposure to non-halal F&B outlets, and also some of the F&B outlets also sell alcohols as well. And coming from hospitality REITs is even much more difficult because the income that they generate is a lot of it is coming from non-compliant or non-halal activities whereby they also have bars, they frequently sell alcohols, they also have clubs, they also have some of the F&Bs being non-halal as well, which is why it's making compliance more challenging for them to be listed as an Islamic REIT. Okay, so next one will be on the tenant due diligence. I think this is pretty much an interesting slide whereby it makes you understand better on what kind of Sharia non-permissible activities that tenants for an Islamic REIT are not allowed to be engaged on, or I would say there needs to be limited engagement in this kind of Sharia non-permissible activities. So some of the activities, or I would say these are basically all being listed by Securities Commission These are your conventional banking, insurance or lending, or gambling or gaming operations, entertainment deemed non-compliant like your adult content, tobacco-related businesses, sale of non-halal F&Bs or production of alcohol, and also stockbroking in Sharia non-compliant securities. So, just to give you some better understanding, this is largely hypothetical lah. When it comes to tenant screening, let's say a REIT whereby they are exploring new tenants, but then the tenant got rejected during the onboarding session because when the REIT did the compliance and everything, they discovered that the tenant actually stored and distributed liquor products. So because it has breached the Sharia guidelines, definitely they couldn't accept lah tenants like this because it would also affect their Sharia compliance status as well. Next thing would be on assessing the percentage of rental income derived from non-permissible activities. So, like I mentioned just now in the earlier slides, under Securities Commission guidelines, whereby a tenant, if they are involved in both Sharia compliant and non-compliant activities, rental from non-permissible portion must initially remain at below than 20% of the total turnover, but then it must be further reduced to less than 5% by the 10th financial year post listing. And some of the assessment approach when assessing the percentage of rental income derived from these non-permissible activities, there are two kinds. Firstly would be on the space-based activities, and second one would be on the non-space-based activities. So when we talk about space-based activities, basically when a Sharia advisor lah, when they want to do their assessment approach, for the first option, basically the Sharia non-compliant rental is basically proportionate lah to the floor area used for non-compliant activities. But in cases when the activities are basically non-space based, the Sharia advisor will assess using ijtihad lah, which is intellectual reasoning. So these are the example of a space-based activity assessment, which is quantifiable lah when we wanna assess it. I think you can see that based on the calculations coming from the example here, like tenant A, there's a mix of non-permissible and permissible business activities that they're involved in. So when calculating the portion of non-compliant rental, it is at 20%. So it still meets that that requirement of remaining below the 20% level of total turnover for non-permissible portion. But then by the time of the 10th year of listing, they need to gradually reduce it lah to less than 5%. So this would be a snapshot of selected Sharia advisors report, whereby I think this is something that you can see on annual reports of an Islamic REIT, whereby they provide you a report by a Sharia advisor, basically stating on the things that they already screen during the particular financial year of the Islamic REIT, whereby, like I said, there's a designated Sharia advisor that will issue periodic reports. They will assess the Islamic REIT's adherence to Sharia principles. And this kind of reports are basically independent views by the Sharia advisor on whether the REIT's operations, income sources, and also investments remain in compliance. So it's also necessary as well for Sharia advisor to provide guidance or comments on any rectification measures when required as well. So these are some of the Sharia advisors report that I managed to extract from the annual report. And examples are like your Axis REIT, KLCC, and also Al-Aqah Healthcare REIT So coming to our final slide, I think this is a perfect example of an Islamic REIT practicing the Sharia compliance So if you look at Al-Aqah Healthcare REIT, these are the things that they did in their businesses or in their operations to be certified as an Islamic REIT. So for the underlying business activities, Al-Aqsa being a healthcare REIT operator, so all of the assets under them are also specialist hospitals and definitely classified as a Sharia permissible activities lah under SC's Islamic REIT guidelines. And in terms of the rental income compliance, if you look into the earlier slides just now, Al-Aqsa Healthcare REIT has a 0% of rental income coming from non-permissible activities. And when it comes to tenant due diligence, because the REIT itself being a healthcare REIT, all of the assets that they have are hospitals and whatnot. So the tenants that they are exposed with are also on the hospital players lah. And on the ongoing Sharia oversight, they also have their own Sharia advisor, which is why you can see that there's also a snapshot of their Sharia advisor report lah, just now in the earlier slide. And when we talk about investment instruments, speaking about this, basically, an Islamic REIT is only I wouldn't say it's only allowed, but it's around there. It's only allowed to invest in Sharia compliant deposits and instruments, and placements in conventional interest bearing accounts or instruments is strictly prohibited lah for Islamic REITs. And of course, on the financing structure as well, it must be Sharia compliant as well, because I think looking into the finances that they manage to secure from banks as well, banks and whatnot, it must be exclusively via Islamic financing instruments. So this is also to ensure that all funding activities must comply with Sharia principles as well. So I think that's it. I'll be ending my slides with a Q&A session. Feel free to ask me any questions or what thoughts that you have in mind by posting it onto the chat box or the question box lah. I'll pass over to Atira. Thanks.
Thank you so much for Ms. Afifa for the insightful sharing. So now I will be sharing my screen. And we're now moving on to the Q&A session. As Miss Afifa said just now, if you have any question, feel free to type them into the Q&A box and I'll read them out for Miss Afifa to answer it. So I will proceed for the first question. Okay. Why is KLCC Staple Securities not called KLCC REIT? Is there any difference? I'm sorry, miss, but I cannot hear you.
Sorry,
Okay.
I'm on mute. Okay, so I believe my screen is still being shared, right? Okay, so I think if we look into
No,
KLCC.
miss, actually I share the screen. So you want to share the screen? Yeah.
Can.
Okay, okay.
Yeah, let me share the screen.
Okay. Okay, that's all.
Okay. So I think if we look into KLCC, right, if you understand the company description, it is not considered or it's not being named as KLCC REIT because it's a staple entity. So when we talk about staple entity, it's a combination of two companies, which is your KLCC Property Holdings Berhad and also KLCC REIT being stapled together into one sole entity, which is why the name is not being called as KLCC REIT lah. But under the stapled group is actually your KLCC REIT and also your KLCC Property Holdings Berhad.
Okay. That's all? So
Yes,
I will moving
I hope it
for
answers the questions lah.
so I will be moving for the second question. What are the main factors to consider before we investing into REITs? How to compare each REIT and how to choose wisely?
Okay, so I think when we talk about REITs, right, we have to understand the bottom line of it is always on the distributions or the dividends. So like I said, when we look into REITs, it's a long-term game. You cannot expect a very impressive 1 year return coming from a REIT like the other if you want to compare with like the other companies or the other stocks like your, let's say, your tech stocks or your property stocks. There's a moment of time that they can manage to get bigger returns than REITs, but returns coming from REITs is basically coming from the defensiveness of the distributions, consistent distributions as well. So to answer your question, when we look into REITs, we have to understand the distribution yield or the dividend yield. So like I said, if you look into this slide here, the slide where I show on the yield between the REITs and other asset classes. I think it's very much better for you to compare with other kind of asset classes, which is yield focus or income focus. So like you see in the slides here, REITs remain attractive given that the yield is higher at 6 to 8%. That is a very achievable target lah when you invest in REITs. But then if you look into like other defensive asset classes like your fixed deposits, your bonds, your 10-year MGS, it's also defensive in nature, just like REITs. But REITs, there's a moderate risk, right? But if you look into defensive asset classes like FDs, your government bonds, the yield that they're offering is even lower. And this is also coming from the lower risk. But I can safely say that a REIT, despite them technically or theoretically sound like they have a moderate risk, I would say the yield so far that they are offering, 6% to 8%, is easily achievable lah.
Okay.
And of course, it's also coming from the fundamentals of the REIT player as well. Like I mentioned just now on the earlier slides on the growth strategies, right? So these are something that you really need to keep track of when investing into REITs. I would say most of the important points is on the strategic acquisitions and also the asset enhancement initiatives, because from this two growth strategy is where you can actually see whether the REIT can actually capture stronger rental upside coming from this growth strategies that they tap on. So like example, like your Sunway REIT, they did some refurbishments on Sunway Pyramid and Sunway Carnival Mall. Given that these two malls are also significant contributors to the group, definitely when they perform asset enhancements, they did refurbishments, the rental upside is even bigger lah, considering how big the contribution is coming from these two assets as well. So it's really on understanding the fundamentals and also on the bottom line lah, whether the dividends or the distributions, is it consistent or achievable or not.
Okay, the next one is talking about investing in rate. Should we first look into the price growing trend or the dividend issuing history?
Okay, good question. I think if we look into the pattern, like the share price movement pattern for any REITs lah, or I would say the ones that I actively cover is Sarway REIT, Pavilion REIT, Axis REIT, KLCC, IGB, Keep REIT, YTL REIT. You can see that the share price movement is always moving upwards. Except for Keep It lah. But I think if you look at the top performing ones, the big cap players, share price is always trending upwards. And reason why is because REIT is all about long-term holding positions. The REITs will always work proactively to acquire new assets, and coming from acquiring new assets, definitely it would translate into higher revenue. And of course, when it translates into higher revenue, the bottom line is on the growing dividends, which is why it's something that you can sleep well at night lah when you invest in REITs, because you don't have to worry about, oh, suddenly the stock would plunge because of some kind of macro factors, because the rental incomes that the REITs receive are pretty much stable lah from their tenants. And I think you were asking about sorry, I think there's like two questions, right, coming from one person just now.
Yes. The other question is, should we first look into the price growing or a growing trend or the
Okay.
dividend issuing history?
Okay, so on the growing trend, I think I already answered your question. And the dividend payment history, what's important to track is on the payout, the dividend payout or the distribution payout. I think REITs, as required, if they want to enjoy tax exemptions, they need to distribute for at least 90% of the distributable income to unit holders or investors. So coming from there, it's pretty much safer for you as an investor when you invest in REITs, unlike the other companies whereby the payout policy is not as high as a REIT. 90% is very high. If you want to compare with other companies, 50 to 60% lah is the typical range for a payout policy by any kinds of company. But coming from the REITs, because there's a requirement by SC, if they want to enjoy tax exemptions, they need to pay out at least 90% of the distributable income. So that's where you can also track lah, on whether what kind of REITs can actually offer you 100% payout, and what kind of REITs that can offer a betul-betul at the benchmark of that 90% payout only. But I would say, in terms of answering both of your questions, it ticks the box lah when we look into the growing trends of share prices, and also if you are worried about the payout, the historical payouts, it's always at 90% and above lah. Okay, next question.
Okay, next question. What is REIT sector that are growing faster in the next 3 to 5 years in the future?
Okay, so if we look into Malaysia market, usually the most appealing REIT is always the ones that are retail focused. Retail focused players, whereby if you look here in the slides, these are your IGB REIT, your Pavilion REIT, and also a little bit coming from Sunway REIT as well. I mean, I think if you look at Sunway REIT, despite them being called as a diversified REIT, most of the assets that they have are also coming from retail assets as well. So, to answer your question in terms of getting that kind of 3 to 5 years growth, I believe it's coming from the capital gains. This would be where you can look into retail REITs lah, because retail REITs so far, if you look at the trend, the historical trend in terms of capital gains, the quantum is much more bigger. But if you're looking for like defensive names, definitely it's your industrial assets lah. But in terms of share price movements and whatnot, it's much more pronounced when we observe the retail REITs lah.
Okay, and I think this will be the last question that I will read. How many times in a year REITs distributes its income to the unit holder?
Okay, so it depends on the REIT player. It can be on a quarterly basis or semi-annual basis lah. But when it comes to a semi-annual basis, basically, sometimes it's every quarter they distribute the dividends, but then it would be paid out semi-annually. So it depends lah on the REIT player itself, and they also disclose it in the annual report lah on the payment schedule of the dividends that they usually do.
Okay, that's all.
I think there's a lot more other questions, but not sure it's reflected on your side or not. Okay, but I think I can help to answer lah some. I think there's a question from Nas Hussein. Advisable to play REITs like trading stocks. I think if you look into REITs, right, like I mentioned, it's a long-term holding position. If you wanna treat it as a trading stock, I would say other sectors or other kinds of companies can offer that kind of platform lah, or that kind of trading strategy, but not for REITs lah actually. Okay, and the question from Shun Ken Su, KLCC has TGV Cinema, stay Sharia. So, like I said, if you look into the threshold of non-permissible income, you can see that KLCC still remains below 5%. So the range is only at 1.25%. So despite them having also the exposure on non-permissible income, non-permissible business activities, although they also have that kind of exposure, but in totality, it's only about 1.25% lah of the Sharia non-compliant rental. So it wouldn't be a problem lah so far for Syria KLCC or KLC Staple Group. And then we also have question from um okay. You meant the unit holders subject to tax on receiving the distribution income. Yes. There's a 10% withholding tax that would be imposed on to unit holders as well. But on tax or for taxes on the REIT level, there's no taxes because they're being exempted. I think I can pass over to Atira.
Okay. Is the last question that you want to answer?
Yes.
Okay.
Since there's limited time already.
Okay. I would like to give a big thanks again to Miss Afifa for answering all the question and sharing your knowledge. And to all of you, thank you for being such engaging audience. I hope you have learned something valuable that you can apply in your financial journey. So before we end, just a quick heads up about our next session. Join us for our next webinar. Bagaimana membaca sentimen dan pergerakan pasaran melalui indikator-indikator makroekonomi on next Monday, 11 August 2025 from 8:30 to 10 p.m. If you'd like to join, just click the registration link that shared in the chat below. For those who haven't opened a stock trading account yet, or if you are looking to open a new one, feel free to scan the form shown on your screen phone. We'll help connect you with a suitable broker. I think that's all from us tonight. Thank you once again for joining, and we hope to see you in the next session. Have a great night and take care, everyone. Thank you.